Hello everyone, this is Ted Bauman here, editor of Big Picture, Big Profits and of the Bauman Letter with your Friday video. It's been a while since you saw me here because I've been traveling. As you can see, I'm not in my normal office. I'm in South Africa, where I'm going to be until the end of July. This is my house. Still busy furnishing it. I've been away for a while, but this is it. Today, I want to talk about inflation and the likelihood that the Fed is going to have to do a lot more than people think it will in order to address it. The key issue here is that the market badly underestimates how much interest rates will need to rise in order to bring inflation under check. If inflation if interest rates do rise by as much as I think they will, that could have pretty big implications for how you allocate your stock investments. So let's start with the picture on the inflation front. Here's a chart that shows the overshoot of inflation relative to the Fed's target rates. And as you can see, going back to really the late 1990s, we've never had a situation where inflation overshot to this extent. I think we all know that, but it's still worth pointing out that this is an historically unusual situation. We had a brief period during 2010, 2011 when inflation overshot a bit, but basically ever since the great financial crisis, the problem has been too little inflation, not too much. The problem there, of course, is that that's the period during which many people who are active in the market today got their wings, as it were, as market traders, analysts, etc. So that's the world they're used to. We're in a different world. The next chart shows really what's driving it, or at least what people think is driving it. This is basically wage increases. This is the year-on-year change in wage change for different types of categories. The overall message or the overall figure is the dark blue line. People who are remaining in their jobs is the green line, and people who are switching jobs, that's the orange line. So basically what's happening is that although we started to see fairly good increases in wages for people who are willing to shop around for better jobs, 4% annualized changes starting in the second half of the previous decade, they're now way up. And that is what a lot of people think is the driver of inflation, is that people are earning more money because of labor shortages and so on. Now, the third chart on the inflation front just shows the relationship between labor shortages and difficulties of trying to find people to work in companies, particularly small companies, and the Fed funds rate. There's a very close fit. As the Fed fund rate rises, eventually the difficulty in falling or finding labor begins to decline. It's a bit of a lag, but essentially what all this means is that when interest rates are low, the economy runs hot and people are able to find, or rather, employers run out of work, basically. They run out of employees, and that makes business harder to expand and so on. But the very far right of the chart shows that as the Fed funds rate has started to tick up this year, we're already starting to see a fall down or a decline in the difficulty of finding new employment now, or new employees. Now, the reason why I focus on all this is because there's this understanding that the primary mechanism that translates shortages and a hot economy into inflation is labor. Everybody likes to point fingers at workers and say, hey, you are the ones who are demanding higher wages. You're the ones who are making inflation go up. You need to be more disciplined. You need to take one in the chin for the economy as a whole. Now, personally, I believe that's bunkum. I think it's motivated reasoning on the part of people who have other interests in seeing inflation decline, mainly because they are creditors. And that means that anybody who's owed money doesn't want inflation to rise, because inflation deflates the value of outstanding debt. It's good for borrowers, not good for lenders. And so the Wall Street voices love to point fingers at labor and say labor is the problem. We're going to see why that's not the case. Now, here's a chart that shows the relationship between the Fed target rate, its policy rate vis-a-vis inflation. When that line is below zero, it means that the Fed's policy rates are significantly below inflation, and that they will need to come up in order to bring inflation down. Now, everybody talks about the comparison between now and the 1970s, but look where we are now. We're actually a lot further down in terms of the difference between Fed rates and realized inflation than we were in the 1970s, which means that if you're using the 1970s as your guideline, that means we still need to hike rates a lot higher than they've already risen in order to be able to get back to where that was. Now, during the 1980s and for the most part during the 1990s, we saw positive interest rates. In other words, interest rates adjusted for inflation were positive. That was the same story in the 50s and 60s. The only other time when rates have been significantly, or real rates have been significantly negative, was in the 70s. Now, as I just explained, after the dot-com bust, we saw another period when real rates were negative. Then they went positive a bit just before the great financial crisis. And of course, that precipitated it because those rising real rates just before that big gray bar before 2010, that's what tipped the housing market into a slowdown, which caused the whole thing to collapse. Since then, as I argued earlier, what we've seen are negative policy rates relative to inflation. But the key message here from that chart is that in order to get this under control, in order to get inflation down, the Fed needs to get those rates up and fast. Now, here's the problem. Despite the Fed's warnings, and despite the warnings of people like Larry Summers and Mohamed El-Erian and others who are warning that inflation or that the Fed needs to raise interest rates a lot higher, the market seems to be pretty chill about all of this. Here's a chart that shows financial conditions. It's basically an index that shows a mix of different things: how easy it is to get credit, the liquidity in the market, and so on. But the key thing is, if you look on the far right-hand side where we are right now, financial conditions are still positive. In other words, they are still in a position to spur economic activity, investment, etc. So right now, financial conditions are still pretty good if you are in business. But if you look back at where they went during the great financial crisis, they spiked quite dramatically. And that was as a result of the cessation of lending, but also rising interest rates and decreasing liquidity. The message from this chart is that right now, we are still a long way away from an interest rate that would actually tighten financial conditions. So in terms of the chart that I showed earlier, the one with that big orange line down below where it was in the 70s, this just reinforces that. Now, here's a chart that shows the consensus, the market consensus of where the target rate will likely be in mid-2023. In other words, 2 years from now. The bulk of the estimates are between a 3% and a 3.75% interest rate. The most significant chunk is in the 3.25 to 3.5 target rate, Fed's funds rate. So that means that right now the market is pricing in increases in interest rates of around, basically 2% from where we are, which would take us up to, pretty low interest rates relative to history. Now, my point in going through all this is to say that financial conditions are still very loose. Interest rates are still historically very low. We're still seeing rapid increases in prices, much more rapid than we've seen anytime since the 70s. It appears to be happening in the primarily in the labor market. That seems to be the main mechanism that translates excessive demand, a hot economy, into inflation. Of course, we know that there's also energy inflation, there's commodity shortages because of the war in Ukraine. All these other things are happening. But there is a long-standing tendency on Wall Street to blame labor for all of this. Now, before I address that issue, let's look at 3 changes to the US economy that suggest to me, as an economist, that if the Fed really wants to cut back inflation, it's going to have to work a lot harder than it did in the 70s. Here's why. The first one is changes in the distribution of stock ownership. This is a chart that shows the percentage of Americans who own stocks. Now, that is, essentially people who have money invested in individual stocks, a mutual fund, or in a self-directed retirement plan. It doesn't include people who have money in pension plans that are not controlled by them. So this is basically people who have active exposure to the stock market. And as you can see, it's declined quite significantly. It peaked out at around 62% of American households back in the mid-2000s. Now we're down to 55%. Now that doesn't seem like it should be a big decline, but if you think about the many millions of households in the United States, that's a lot of people who no longer play the stock market. And that means that those people are not likely to be swayed by something called the wealth effect. Now, let me pause there and explain the wealth effect. The wealth effect says that when the stock market is hot, when asset values are rising, people feel better, so they spend money. Spending money then creates demand, which then leads to rising prices if there are shortages of labor and other goods. The reverse wealth effect happens when the stock market and other asset values fall and people don't feel as rich as they used to. For example, in the great financial crisis, when the housing market collapsed, all of a sudden, people said, hey, I don't own a house that's worth 100 or 200,000 more than I paid for it. I'm now $100,000 or $200,000 underwater. I can't afford to go out and splurge on vacations or buy durable goods or anything like that. So the logic is that the wealth effect operates by affecting people who own assets, particularly houses and stocks. Now, here's another chart that shows who owns basically equity holdings. Now, the critical thing is that this is equity holdings by value. So, it's basically the amount of the total market value of U.S. stocks that are owned by U.S. households. Now, there's two measurements here. One is 1989 and one is 2016. I know that's a bit dated, but this is the most recent I was able to get. Now, the critical thing here is that the bottom 50% of the U.S. population owns essentially no stocks. They owned a little bit in 1989, but now it's negligible. The households between 50 and 90% of the net worth percentile, their stock holdings have been cut by half since the late 80s. Those in the 90 to 99th percentile of the wealth distribution, they've cut back a little bit. But the top 1% and the top 0.1% have expanded their stock holdings very significantly. Now, the reason why this is important is because if the Fed is counting on the wealth effect to cut back on consumer expenditure, particularly on durable goods, then they're going to have to go higher than they did back in the 70s, because back in the 70s, stock ownership was much more evenly distributed than it is now. So look at it this way. If the wealth effect is meant to cut back on spending by cutting back on the value of people's asset holdings, if very few people in the country own assets, interest rates have to go a lot higher to get them to cut back on their spending. And that's a direct effect of the inequality in the ownership of stocks. So that's one big difference between now and the 1970s. Next big difference, a change in the proportion of imports in GDP. Here's a chart that shows where imports were basically going back to the 1940s. But look at the level of imports as a percentage of GDP back in the 70s, around 5%. It was rising as globalization began to take off. But look where we are now. We've been as high as 15%. We've backed off a little bit in the last decade or so, but right now we're over 12.5%, probably around 13% imports as a percentage of GDP. Now, again, this is a critical issue. If the goal of Fed policy is to raise interest rates to slow down the economy, the way that works in practice is that you raise interest rates, you make borrowing more expensive, you make investment in fixed income like treasury bonds more attractive. That leads households and businesses to cut back on investment because they say, well, it's more expensive now to borrow money to, say, invest in my business, or it's more expensive to buy a new washing machine or whatever on credit, so I'm not going to do it. And now all those decisions cascade through the economy, and that leads to a slowdown in the economy. But when you have a lot of imports as a percentage of GDP, those companies are not being influenced by interest rate policy in the United States directly. They're not thinking in terms of U.S. interest rates in their investment decisions. They're not going to be amenable to the effect of interest rate increases in terms of pricing of their goods and their hiring of labor and all that sort of stuff. So other things being equal, the more imports as a percentage of GDP, in other words, the more foreign stuff we consume, the harder it is for the Fed to translate interest rate increases into a decline in inflation. Now, of course, if overseas goods are falling in price, that's a good thing. That helps the Fed. But if overseas goods are rising in price, as we're seeing in Chinese goods, because of because they're basically cutting back in production, locking down their cities still, if you can still believe it, they're still trying to stop COVID from spreading. That's insane. But what they're doing is essentially cutting back on production and rising prices. My point is that just like the increasing inequality of stock ownership, this makes it more difficult for the Fed's interest rate policy to address inflation. Not a huge amount, but enough to make it likely that the Fed will have to raise interest rates higher now than it did in the 70s. Now, let's get back to the big question for me, which is what's actually driving inflation and what would it take from the Fed to be able to get this under control? Well, the third big change we're seeing is that whereas in the 1970s, inflation was driven by a spiral between wages and prices, now it's a spiral between profits and prices. Now, in the 70s, if you remember, one of the big issues was that unions were strong. They were in a position to say to their employers, look, if prices are going up 5 or 6% per year, then we want wage increases that are 6 or 7% so we have real income growth. And they were strong enough and they had enough, they had the capacity to go and strike and so on that they could actually force employers to go along with that. That led to a chase. Every time wages went up, prices would go up because wages are a big proportion of input costs. But then prices would then feed back into wages and they would spiral upwards. That's why Paul Volcker slammed the brakes on the economy so hard in the beginning of the 1980s. Interest rates going up to nearly 20% to just collapse the whole economy in order to get things under control. Look at what's happening today. Here's a chart that was recently compiled by some research analysts who showed that from January 20 to January 22, the contributions to wage or to price increases from wage growth and profit growth are not what people think. The contribution, this is basically the producer price index. So this is not consumer prices, this is producers, but it's still critically important. The producer price index has increased by 36 points. The contribution to that comes from increasing profit margins in US companies is 12.6%. The contribution of that increase that comes from an increase in nominal wages is under 4%. Now, that's critical because what that's telling us is that unlike the 70s, what's happening now is that companies are raising their prices in order to keep their profits up because earnings are what drive their share prices. Back in the 70s, they didn't have that pricing power. The economy wasn't as uncompetitive as it is now. We didn't have as many monopolies and oligopolies that allowed companies to raise prices without having to worry about competition. They could just basically someone do it. Now, what that means is that other things being equal, in order to address inflation now, you've got to do it in a way that actually begins to put the hurt on companies and their profits, which is not good for the stock market. Whereas back in the 70s, you could focus on labor. Here's another chart that shows something similar. It shows the contribution to growth in unit prices in the non-financial corporate sector. In other words, in US companies that are not like Wall Street companies, during 1979 to 2019 versus 2020 to 2022, the first quarter of this year. Well, back in 79 and 19, unit labor costs definitely were the big driver. 56% of the growth in product prices were driven by labor. Non-labor inputs were about 31%, and corporate profit increases were about 13%. Now, since 2020, unit labor costs are only responsible for about 20% of the increase in unit prices. This is different from the previous graph because this is all products, not just producer goods. But look at non-labor input costs. That's commodities and other materials, raw materials. That's a big driver, much bigger than it was between 79 and 2019. But look at corporate profits. Corporate profits are contribute 38% to the increase in prices, which is significantly above that of labor. Now, this is important because if people are telling you that labor has to take it on the chin in order to bring inflation down, and if I'm right that these structural changes in the economy, the decreased impact of the wealth effect, the increased proportion of imports in our GDP, and the ability of companies to raise profits at the same time that prices are going up, if that's the case, then the Fed is going to have to increase interest rates significantly above where they were, in the 1970s. In other words, their ability to rein in inflation, they're going to have to raise prices by a lot more than they did, than people expect, basically. Now, that's dangerous. Here's a chart that shows or simulates the likely impact of a simple 1% increase in the interest rate on real GDP, unemployment, and the inflation rate. The top line is the unemployment rate. So we're likely to see unemployment rise fairly significantly. I think, for 1% increase, that's not, I think we're going to need a lot more than that. But here's what it would do. Then you have inflation down the thick dotted line. Well, that's what inflation would do, but look at real GDP. A 1% increase in the interest rate will slow real GDP growth by a whole percentage point. Now, if I'm right that we're going to need something like 2, 3, 4, maybe even 5 interest rate increases to bring inflation down, you can just imagine what that's going to do to unemployment and the real GDP. Now, why am I saying all this? Well, not because I want to scare you. I just want you to know the facts. And the facts are that, yes, interest rate increases are necessary to rein in inflation, but the market is not pricing in interest rate increases as big as they will need to be based on history and based on the changes in the structure of the economy since the 1970s. That means you should be looking at stocks that are interest rate resistant. And that's why the Bauman Letter has been focusing on companies that pay dividends, that have strong balance sheets, that have strong cash flows, that are not susceptible to damage as a result of interest rates, and in fact, sometimes benefit from interest rate increases. And I've got a couple of those in the real estate investment trust segment, but also a new pick that's coming out soon in a financial sector that actually improves profitability very significantly when interest rate goes up. So I've posed a problem. I'm offering you a solution. Check the Bauman Letter. You can see a link to sign up down at the bottom and in the corner of this video up in the upper left-hand corner. Anyway, this is Ted Bauman signing off. I'll talk to you next week.